Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Welcome to another episode of the Real Estate Investor Podcast. I'm Gary Lipsky of Break of Day Capital, and I'll be talking to our frequent guest, Joe Fang. Joe, welcome to the show.
Hey, Gary, good to see you again. Hi, everybody.
Most investors rely on gut feelings, shiny brochures, or hype, and that's exactly how people miss red flags and lose money. At Break of Day Capital, we do things differently. We help investors make smarter decisions before the deal ever hits your inbox. From our educational webinars to our Invest Smart book to real tools like our portfolio tracker, we're here to give you the edge most investors don't even know they need. If you've been valuing our podcast and want to take the next step, subscribe to our newsletter. You'll get early access to webinars, new investor tools, and market insights sent straight to your inbox. Break of Day Capital, because smart investing starts before the deal.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
So there's a few things I wanted to cover today. One, getting a new deal under contract after over a year. Two, NMHC, and then three, let's touch on the macro outlook.
Speaking of our latest deal, this is only our fourth deal in just under 4 years. It's been so hard finding something that fits our stringent criteria.
Yeah. We've looked at a ton of deals in the last year. We thought we won a deal and the seller backed out because they were going to lose a lot of money. And then we had another one, as you know, under contract. We did due diligence, and that was, I would just say, it didn't go as well as we had hoped to go, and ultimately had to back out of that deal, unfortunately. But patience pays off.
Yeah, when you finally get one that checks all the boxes and and no showstoppers, you just have to go for it. They're pretty hard to come by.
Yeah, when you're getting basis at well below replacement value, that is exciting.
Yep. Did you want to get into a little bit more about this deal right now? What we might want to do to it?
Yeah. So it's not a big lift as far as like unit renovation and stuff like that, but we've also seen tremendous value in doing deferred maintenance, and as a way to reduce retention and retention costs. So you're reducing marketing spend. And we're able to push rents. And so when I talk about deferred maintenance, certainly can use a new paint job, landscaping. They have some quite a bit of dead trees. I mean, I think when we did the map in trees, there was over like 75 trees on this property. So really beautiful property, but definitely some trees that have to come out. Also, they've had a lot of issues with they have two boilers that need to be replaced and the boiler lines. And so for some residents, it takes almost 10 minutes to get hot water. And so when you fix something like that, it's your retention is going to go sky high from there, because if you have to wait 10 minutes for hot water, that's problematic. We'll also redo the parking lot. When I say redo, we'll do this, fix the issues and do a slurry coat, and the roof as well. So these things should make the property stand the test of time for many years. And like I said, reduce costs, utility costs, marketing costs, the leasing costs, stuff like that. So really we can focus on there and get the bulk of that done within the first, let's say, 8 months, and really focus on operations.
Yeah, I think I've been on the property and it shows really nicely, and I think just implementing, the things that you talked about. And it's not a heavy lift, which also means less risk for our investors too. So going in, we're probably going to be able to see, decent cash flow right off the bat, which is, we haven't seen, oh, well, the last few deals we have, but before that, it was really hard to get, decent cash flow going in. So yeah, this is really nice that it's relatively, lower on the risk spectrum. And I think with all the things that you mentioned, it's going to give some more energy, sort of you know, some fresh blood into the place, and we should be able to do pretty well with this property.
Yeah, and that's, when it's the end of the investment cycle for the seller, and so they've had it a number of years, and deferred maintenance does build up over time because you've used your capex and whatnot, and so that's a good time for them to sell and for us to come in with, like you said, fresh blood, because they've done a good job and the property management company has done a good job, but we invest some more money to um take out the wrinkles and
Yep.
give it a fresh look, and pow, it becomes a lot more desirable for residents.
Yep.
So if you were an investor right now, Joe, what would you do?
Yeah, that's a good question. So, let me just start off by saying that, it's tough if you don't have any dry powder. But if you did, I think it's a great time to buy into a sector where, either, there has been a lot of fear, uncertainty, and doubt, or even just apathy, and I'm referring specifically to multifamily, but I think that if you can just use a little bit of imagination and patience, rates are coming down. This administration is hell bent on getting rates down, and liquidity is improving. The Fed ended QT, and they have soft QE going on right now. They're buying 40, $50 billion of short-term debt, every month. Which overall should provide a lift to the general economy. Uh, what I would also say is that the worst thing you can do is to buy into a hype asset, and multifamily is far from it.
Yeah, quite. Yeah, it's the exact opposite right now. I think, and that's the best time to buy when it's not herd mentality and tons of capital aren't flowing in. There's a lot of dry powder looking for the best deals. Um, so it's this time when there isn't the hype to buy, because when there is hype, then prices is much higher.
Yep, absolutely.
So a lot of real estate investors obviously pay attention to the Fed and interest rates, and it has a big effect on us as investors. What do you think about Trump's choice um, to head the Fed? About like Warsh's policies and stuff.
Yeah, this is the $1 million question, and one that seemingly has given the markets some jitters recently. Warsh was a little bit of a surprise. He's the least dovish, or put differently, the most hawkish out of the other candidates, namely Hassett, Waller, and Reeder. The markets are worried that he's going to shrink the Fed's balance sheet, which is otherwise known as quantitative tightening. Right? We just came out of that, so the market's scared that he's going to go back into doing that. Which would obviously remove liquidity and potentially cause asset prices to go down. Now, Warsh was a Fed governor, I think under Greenspan, and he was very critical of quantitative easing, during the 2008 Great Financial Crisis. But we do believe that he will cut rates, as this is what Trump wants to help Main Street. This is what this current administration thinks that will be most beneficial to Main Street. I am somewhat skeptical that he's going to be able to reduce the Fed's balance sheet all that much, at least at the in the beginning, because if doing so would cause major issues in the financial plumbing, and I just don't think they'll risk that during the midterm election year. And frankly, we don't even know if that's possible, right? It's going to have to get tested. Now, keep in mind, though, that this administration has repeatedly said that they want to reduce the role of the Fed and basically transfer money expansion to private banks by reducing regulatory hurdles, like changing the reserve requirement. The point is that they really want to minimize the role of the Fed, the government, and really try to encourage the private sector to take over. For it's the private sector's turn to sort of be the creator of growth. So, just as a reminder, in the current setup that we have, the Fed is actually paying private banks 4 to 5% interest just to park their cash with the Fed. And what that's doing is it's not incentivizing banks or even restricting them from lending to more to businesses, because they're like, well, if I can only get 6 or 7% on a mortgage, but I can make 4 to 5% with the Fed risk free. Why don't I just do that? Why do I want to take on more risk, right? So we have to do things, or the policies have to change to encourage banks to lend again. And I would add that Walsh also believes that artificial intelligence is highly deflationary, and I think we're starting to see some of that now with select layoffs, and therefore, despite Besant saying that they want to run the economy hot this year, which is another good thing, he's not afraid to lower rates in a growing economy. Some have even compared Walsh to Greenspan, because this is how Greenspan ran, the Fed, back in the early 2000s. Lastly, it's important to note that having Besant at the Treasury and Walsh as the Fed chair, there's going to be better coordination between both agencies, and better coordination in terms of the fiscal and monetary policies, not this back and forth tweet wars between Trump and Jerome Powell. I mean, it's just silly, but that has to go. That's got to go away. You can almost bet that Walsh might have been picked by Besant obviously with Trump's blessing, but they were both colleagues working for Stan Druckenmiller's Duquesne Capital. And honestly, without making any political statements, these two guys are very well qualified to fix the financial plumbing and get the economy rolling again while keeping inflation subdued. These guys know what they're doing. So Gary, let's shift gears a little bit and go back to multifamily. You were recently at the NMHC, which is the National Multifamily Housing Council annual conference in Vegas. What did you hear? What was being discussed between all the brokers, the operators, lenders? Can you just give our audience a little bit more color on that?
Yeah. I would say there was kind of like a neutral feeling. Um, if you were there last year, you would have thought we would have had some rent growth and some more deal flow in 2025, and there was more deal flow. So, take Phoenix for example, they had 24% more deal flow in 2025 than in 2024. So that's good news, and they expect the same amount in 2026. Now, it wasn't like 2022 when everything was selling like crazy and the deal flow was crazy, but the more deal flow, the better. It just greases the wheels. It allows liquidity for investors, but there's still a little bit of pain to get through. Obviously, cap rates are still high. They haven't come down yet. There's a lag when interest rates come down. We haven't seen that yet. Hoping for some rent growth in second half. Now that keeps getting pushed out because obviously we were thinking about that in 2025 and that got pushed to 2026. But um, good news is insurance costs have come down, which is good, or flatlined, whereas before it was skyrocketing. Um, but there's still other things on the expense side that have crept up. People are spending more on marketing to boost their occupancy. You still have a little higher concessions and delinquency than you've had before. So asset managing properties are takes a lot of work and a lot of expertise. And I think a couple of years ago, and I've said this before, not enough people were talking about asset management or really honing in on that. And it's a craft, and it's a craft that you have to keep learning new tools and pivoting and growing. And that's something that we obviously invest a lot of time and money in, because we're always learning new tactics and new things all the time, and seeing what works, and tweaking it or pivoting to something else when that doesn't work. And so it's a lot of work on the asset management side, but certainly a lot more people at NMHC were talking about that, and also talking about not a wave of, let's say, delinquency, but there's still some more pain to get through for deals that were bought at 2022 levels, that have just simply lost value. So when we get a basis for 110 a door for the property we have under contract now, that's amazing. But for deals legacy properties that are like from 2022, that's not a good thing. It's great to be a buyer now, not good to be a seller. So you've got to find more time to get values up for some of those older deals, and that's a struggle that a lot of operators are having to work through.
Yeah, I definitely see that in some of the deals I've invested in. Um, what about the lenders? What are you seeing on the banking on the lending side?
Yeah, so I haven't really seen it as much, but certainly people are talking about more lenders coming in, getting a little bit more aggressive now. Not 2022 aggressive when you can get 85%, 90% leverage, and really low rates at the time, and obviously at that much leverage is quite a bit dangerous, if rates change on you and you have short term loans. Um, and 80s product is starting to become a little bit less desirable for lenders, as it gets a little bit older. So it's just something you have to keep an eye on. But more lenders are getting a little bit more aggressive, and particularly with Warsh coming in, I think you'll see more and more of that as well, based on the policies that you mentioned. Um, so that's another reinforcement of why it's a good time to buy now, because as lenders get more aggressive, um, then the buying power goes up and you're going to spend more. So while we're in this where it's tougher, it's not the easiest to raise capital and to get these deals under contract, but when things start moving very favorably, that price is going to go up quite significantly, very quickly.
Yeah, yeah, no, that makes me, as I zoom out, perhaps getting a little philosophical, but I think everything in life is cyclical. What goes down will eventually come back up, and vice versa. And just sort of, because we pay so much attention to the real estate industry. I feel as though the industry has gone through you know a range of issues, from major suffering in like the commercial office space, things that are like now trading 30 cents on the dollar. And it's I'll tell you a quick funny story. No, it's not a funny story, but just a quick anecdotal. I remember when I was going to USC long time ago. I'm not going to date myself here, but there was a major like Korean owned commercial owner that basically like everyone was always talking about. Oh my God, these guys are so awesome. They own like half of Koreatown or half of downtown, whatever. And it's really sad because just recently, I think a second half of last year, I think I read that they're pretty much going to lose their entire portfolio, or like something traumatic. It's just crazy. You just these things. So anyway, ranging from like um, you know borderline catastrophic, to just treading water, like what we had to deal with in multifamily over the last few years, simply because the Fed had to stall the economy. They overstimulated post COVID, and we got a bunch of inflation, and they panicked, and they had to tighten up so quickly, so rapidly, and for us to have to deal with the aftermath. you know but having said all that, I feel like we're starting to come out of it. Uh, this administration, they want to grow the economy hot, because we tried cutting, right? We tried cutting government spending, and that was hit. That was hit with a lot of pushback. And so the only other way you can do is to increase the growth, right? And so they've already said that this is not conjecture. They've been talking about this since they got into office. They're going to grow the economy, and they're gonna lower our cost of capital, which most businesses are very sensitive to. We're all very cash flow dependent. So I think relief is finally coming. And so with that, I see green shoots. We're buying a good asset at a very low cost basis, and I think we're about to get some macro tailwinds behind us as well. Now, we're not projecting that, but I could see it happening. Just to kind of leave the audience with one economic data that just came out earlier this week, which is a pleasant surprise, which is the latest ISM manufacturing PMI. That's a mouthful, but just all you need to know is that number. If it's above 50, it signals that the economy is growing, and if it's below 50, the economy is still shrinking. So that number came in around 53, which was way bigger than the estimate. And we haven't seen a number like this. We haven't seen this number well above 50 since 2021. Okay. So I think the next year or two should be quite favorable.
That would be amazing. I know my crystal ball broke a couple of years ago, but yeah, we're well past due for that, and I strongly believe that's coming as well.
Yeah, well, Gary, I don't know if there's anything else you want to cover, but I feel like we gave our audience a lot. So maybe this is a good place to say see you later.
Yeah, Joe, I appreciate you coming on and sharing your expertise. That's a wrap for today's episode. Joe Fang, Gary Lipsky. We'll be back soon for another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.